The SEC is preparing for a market collapse and is desperately trying to ensure that hedge funds don't tank the entire financial system. Today I want to talk about how exactly the SEC is preparing and how this is going to impact the AMC squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, anonymous market maker tweeted saying the SEC wants to ensure that hedge funds don't tank the entire financial system. But he says, Gary Gensler, it's too late for that. You should have been doing your job. Now this links through to a Barron's article with a paywall, but somebody on Reddit has managed to skirt around that paywall and has copied the entire article. It says regulators are launching a new effort to make sure hedge funds and other private investment advisors aren't hiding any bombs that could blow up the financial system. It says the SEC on Wednesday proposed amendments to a confidential reporting form for private funds that it and other agencies use to assess where risks lie in the broader financial system. It's an effort to keep pace with the growth of private firms, which the SEC said has grown by nearly 150% in asset value in the past decade, and the evolving trading strategies that such funds employ, such as illegal naked shorting. If adopted, the amendment would, for example, require the funds to break out their digital asset holdings and to report certain kinds of investments, like litigation finance, with more granularity. Now, this is going to show the Financial Stability Oversight Council exactly what kind of risks private funds are taking and how those exposures might threaten the entire financial system. This is obviously as a result of the Archegos firm blowing up last year, and the SEC is now trying to make moves to ensure these private firms and family offices are disclosing more information on what kind of trades they're taking. The SEC and the Financial Stability Oversight Council want to see exactly what kinds of trades they're taking and exactly what kind of financial derivatives these firms are using. Back in the day, stocks could either be bought or sold. Then came along shorting and, as a result, illegal naked shorting as well. But now it's gone one step further, and this illegal naked shorting is now being hidden in married and divorced puts in the options chain and also in these total return swaps as well. The SEC and the Financial Stability Oversight Council are obviously massively behind in this practice, and they need to catch up and they need to figure out what kind of trades these private firms and family offices are taking. But it's not only that. The SEC is now starting to realise these clearing agencies like the DTC, the DTCC, the NSCC, the OCC, and all of these other clearing agencies now can't really be trusted to be self-reporting agencies. Malfunction tweeted saying, breaking news, the SEC is proposing to remove the DTCC's self-regulatory organisation status and turning it into a regulated government agency. And he said this is huge. The SEC and Gary Gensler are potentially fighting for us, mostly just to ensure the stability of the overall financial system. I don't really think the SEC and Gary Gensler are fighting to protect us. They're most likely realising these self-regulatory organisations and these private offices just simply can't be trusted to not destroy the entire financial system. And he said, remember the Citadel employee on the board at the DTCC? This new regulation would remove that type of conflict. So the SEC has proposed new rules to improve clearing agency governance and to mitigate conflicts of interest. Now you may say, Tom, what exactly is a clearing agency and who exactly are the clearing agencies? Obviously you've got the DTC and the DTCC, the NSCC, the FICC, the OCC, the ICC and a few others as well. But ultimately these proposed rules would establish new governance requirements on board composition, independent directors, nominating committees and risk management committees as well. aka the DTCC will have to restructure its governance department, avoiding conflicts of interest, aka no more representatives from Citadel, no more representatives from JP Morgan Chase or from Goldman Sachs or from Citibank or from any other of these major banks should any longer be on the board at the DTCC. And importantly, it says if adopted, the proposed rules would increase transparency of the decision-making process on clearing agency boards and committees and improve the alignment of incentives between clearing agency participants and the owners. That way, these clearing agencies will no longer be self-regulated organisations, and they will be making regulations and making decisions for the right reasons. They won't simply be ignoring criminal activity because one of their board members is affiliated with the criminal organisation or the criminal company. There's effectively going to be separate external management or separate external governance that ensures the right investigations are performed against the right firms. And if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get a whopping total of up to $25,000 in those 10 free stocks. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not sell your order flow to market makers like Citadel, and therefore Moomoo is brilliant for buying those AMC and GameStop shares. And Moomoo has officially announced they will be handing out the APE dividend to everybody that holds AMC shares in their account on August 22nd when the APE shares are distributed. Now, another way the SEC and the OCC are preparing for this coming market collapse is to file a new advance notice expanding the non-bank liquidity facility program. Now, this is basically saying the OCC is obligated to make certain payments in the event of a clearing member default. The OCC would be obligated to make those payments on time related to that member's clearing transactions. Now, obviously, this is in preparation for this market collapse and for many hedge funds to end up going bankrupt because obviously the DTCC and the OCC has to mop up any responsibilities of that defaulting member. This new regulation is saying the OCC now believes it should seek to expand its current liquidity facility to increase the OCC's access to cash to manage a member default. Now, worryingly, the OCC wants to access stable and reliable sources of funding without increasing the concentration of its exposure to counterparties that are affiliated banks. As a result, the OCC wants to access stable and reliable sources of funding from pension funds and from insurance companies. Basically, the OCC wants to, in the event of a clearing member default, they want to access the liquidity and effectively drain pension funds and insurance companies. Now you may say, Tom, that's absolutely terrible. How can the OCC just simply drain these pension funds in order to prop up and mop up defaulting clearing members? But Darren Harper has also tweeted this screenshot showing that Biden is to unveil a bailout plan for multi-employer pension funds. It says the federal government's private sector pension insurer is expected to soon unveil a permanent rule detailing its long-term strategy for bailing out severely underfunded or drained multi-employer pension plans. Back in 2021, Congress approved $94 billion effectively to bail out these underfunded and drained multi-employer pension plans. Maybe this time around in 2022, this bailout plan is only going to increase. So it seems like the SEC really is preparing for a market collapse. They're improving the disclosures around these private funds and these family offices. They're restricting or removing the ability for the DTCC to be a self-reporting organisation. They're improving the OCC's and the DTCC's access to cash for defaulting members, but at the same time propping up and protecting those pension plans that are potentially about to be drained. But you may say, Tom, the S&P 500 and the Nasdaq are up like 20% from their bottom. As Michael Burry tweeted, he said the Nasdaq is now up 23% off of its low. He said, congratulations, we now have the average bear market rally. Across 26 bear market rallies from 1929 to 1932 and from 2000 to 2002, the average was 23%. And he said after the year 2000, there were two 40+% bear market rallies and one 50+% rally before the market bottomed. Even though we have seen the Nasdaq bounce up 23% off of its low, it's likely this is just simply a bear market rally and the market crash and the market collapse is set to continue. Now, over the last few months, I've spoken about many tech startups and many crypto companies that have been cutting headcount, forcing layoffs and freezing hiring. I obviously also spoke about Apple doing the same thing and also Walmart doing the same thing as well. But next in that line is now Microsoft. First Squawk tweeted saying Microsoft is cutting hundreds of contractors early, cancelling their contracts amid layoffs and a hiring freeze. So Microsoft aren't just implementing a hiring freeze, they're also forcing layoffs and they're also cutting hundreds of contractors' contracts mid-contract. Google executives have been threatening workers with layoffs, saying there will be blood on the streets. And on top of that, we're also seeing crypto companies like Coinbase generating a quarterly loss of over $1 billion. So it's not just big tech companies that are experiencing losses and forcing layoffs, it's also these crypto companies that are experiencing giant losses, giant multi-billion-dollar losses in a single quarter. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.